This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of our previous session together, looking at group relief, we raised one particular, well, not really practical issue, but eminently examinable issue. And that is the situation where, unlikely though it may be in reality, as we've said, but one of the companies within the group that makes a loss has a different accounting period end to another company or companies within the group that make profits. Now, what we know is that group relief will only be available in relation to coterminous periods, corresponding accounting periods. And we briefly discussed the section that you can see here highlighted. So where the accounting periods of two group companies are different, then group relief will be restricted to the part of those accounting periods that correspond, the coterminous periods there. It is necessary, therefore, to time apportion both the loss-making period and the profit-making periods to calculate how much loss may be set against how much profit in each chargeable accounting period. That's the theory. Let's have a little look at the practical application of that now. So here we have a little example that we have pre-prepared for you. I'll talk you through it while you note it down. What we've got here is the loss-making company. And the loss-making company within our 75% group, obviously for group relief to be available, we must have the 75% group membership. But we have a loss maker that prepares accounts to the 31st of December in each year. And for this, the year ended 31st of December 18, so from the 1st of January through to the 31st of December 18. It has sustained a loss of £0.8 million, some £800,000. But the company against which we will relieve those losses, its profits are computed based on a year ended 31st of March. Now, of course, that means that a part of the loss-making period, the year ended 31st of December 18, corresponds with a part of the profit-making period of the year ended March 18, and also partly of the year ended 31st of March 19. So I've done it there in the form of a timeline, or two timelines for the loss-making and for the profit-making period, just so we can then appreciate exactly which periods overlap, which periods correspond. So we've now got to see how much of that loss of 0.8 million may be group relieved against, firstly, the profits of the year ended March 18, and then the profits of the year ended March 19. Now, I think we can see, hopefully without too much difficulty, that we have got some 3 months there to the 31st of March 18. 3 months of our loss-making period corresponds with 3 months of the profit-making period to the 31st of March 18. So when we group relieve here to the profit maker, for the year ended 31st of March 18, how much loss do we have available? Well, we've got 3/12 of a loss of 0.8 million, which will therefore be a loss of 0.2 million. I hope we'd agree that there 3 months of the year ended December 18 correspond with 3 months of the year ended March 18 for the profit maker, and therefore only 3 months of the loss may be group relieved against 3 months of the profit of the year ended March 18. So what that means is not only must we time apportion the loss-making period in terms of the loss available, that is 0.2 million, but we've then got to look at the profit-making period as well. Now, the TTP for that profit-making period of the year ended March 18, as you can see, is 0.6 million. So 3/12 therefore of 0.6 is 0.15 million. 150,000, 0.15 million. So although there is £200,000 of loss available that corresponds with the year ended March of 18, only £150,000 of profit is within that period. Therefore, that is your maximum group relief. So the maximum amount of the loss of the year ended December 18 of the loss maker that may be group relieved against the profits of the profit making period year ended March 18 is £150,000. So whichever is the lower of the two figures, the amount of loss or the amount of profit, the amount of loss that is available to surrender, the amount of profit that is available to be relieved, whichever is the lower figure represents the maximum amount of group relief available. So we'll now apply that for what is the year ended March 19 profit making period. Well, in terms of what loss, the remaining 9/12 of the loss of 800,000, i.e. £0.6 million worth of loss, is available to go against 9/12 of the profit. And what was the profit of then the year ended March 19? That was 1 million. So 9/12 of £1 million profit will be £0.75 million worth of profit. So this time, no problem in group relieving all of the available loss to surrender to the profit-making claimant company. The £600,000 of loss available to go against £750,000 of profit. So there we're now able to establish the amount of group relief available from the loss maker's year ended 31st of December 18 that corresponds partly with 3 months of the year ended March 18 and 9 months of the year ended March 19 of the profit maker. Again, we must look at the coterminous, the corresponding periods, how many months of loss against how many months of profit in each of those two periods, and whichever is the lower of those two numbers, that will be the amount that is the maximum group relief. Obviously, you do not have to group relieve all of that figure. You've got available there 150,000, available here 600,000. You are able to group relieve, of course, any amount up to that figure. Okay, one other possible issue here. Now, with our profit maker, I gave you the year ended the 31st of March 18 with a TTP of 0.6 million. Imagine now that instead of the year ended 31st of March 18 that we were dealing with, we know there is the accounting date, the 31st of March. But if I now told you that this particular business commenced trading on the 1st of October 17. So that particular company, the profit maker, made still a profit of 0.6 million, but this time it wasn't for the year ended 31st of March 18. It was for an opening period from when it started to trade on the 1st of October 17 through to the 31st of March 18. Well, that, of course, is a 3-month period. So, when we come now to deal with the group relief to the profit maker, how much period corresponds loss making to profit? It's still 3 months. There's a crossover of 3 months from 1st of January to 31st of March 18. The loss making period was a 12-month period. So what we still have is 3/12 of the loss of £0.8 million. So we've still got available a loss of £200,000 to be group relieved. And it will still go against 3 months worth of the profit. But this time, of course, the profit making period in which we made £0.6 million worth of profit is not 12 months, now it is 6 months. So 3/6 of 0.6 million is, of course, 0.3 million pounds there. And what that means is that whereas previously, though £200,000 of loss was available for relief and is still available for relief. When it was going against the profits of the year ended 31st of March 18, we could only take 3/12 of 600,000. That was 150,000. It limited the group relief. Now, it is no longer the year ended 31st of March 18. It is the 6 months to the 31st of March 18. Therefore, again, 3 months of that 6-month period correspond with the loss-making period. But this time it's 3/6 of the profit of 0.6. That is 0.3 million. That means, of course, that now all of that 200,000 is indeed available to be group relieved against that £300,000 of profit. No restriction now in the amount of that loss available to be group relieved in what is its corresponding period of 3 months. So again, don't always assume that when you do time apportionments that the denominator involved is going to be 12 months. It would be usual, of course, for that to be the case because we'd expect to see 12-month accounting periods. But if a company, for example, was either as they're starting to trade or ceased to trade, or it only joined the group or left the group partway through the period, then of course we may have a different time apportionment exercise to perform. Okay, with that in mind, therefore, again, do have another look back through that, make sure you're happy with the exercise that we've just done. But then in relation to back in your notes, there's a couple of exercises for you to do.
Well, we'll return briefly now to the FA 2019 material, as when we look at these problems in group relief of non-coterminous accounting period ends, the name in which they glory there, these non-coterminous accounting period ends, it is all about dates. And of course the difference between the FA 2018 and FA 2019 notes is simply that the dates are different. So to make sure that we don't have any problems with that, we're now going to look at example 3 from within the FA 2019 notes. Now, back in the previous lecture where we got introduced to example 2, upon which example 3 is based, we saw that in the FA 2018 lecture, the accounting period used for the ZPLC group was here, the year ended 31st of March 19. All we'll have done, as you will have seen already from the FA 2019 material in front of you, is to bring that date forward to the 31st of March 21. So we brought forward 2 years. So we're now going to assume that for purposes of dealing with example 3, that in example 2, the accounting period, consistent with your FA 2019 material, was for the accounting period ended 31st of March 21 there. Okay, so what is example 3 asking us to do? Discuss the group relief available in respect of ZPLC's trading loss for the year ended 31st of March 21. Again, we were told that for that accounting period, in example 2, Z had made a trading loss. We then looked at a fairly strange group structure where we went from direct to and then further indirect subsidiaries. But what this is just asking us to look at is what would happen if it were to consider surrendering the trading loss to B Limited. So the group relief available, ZPLC's trading loss for the year ended 31st of March 21, if it were to consider surrendering the trading loss to B Limited. What we're told now in example 3 is that B Limited has only just started to trade. So consistent with the classwork example that we were looking at just a little while ago, we now continue with example 2, but suppose that B Limited had only commenced to trade on the 1st of October 20 and prepared accounts for the 6-month period to the 31st of March 21. Now, given that we're dealing with Z with a year ended 31st of March, here now year ended 31st of March 21, at least that accounting date is the same. The only issue is that B's limited trading period, although entirely consistent and falling entirely within the accounting period of Z, for Z it's a year ended 31st of March 21, but for B Limited it's only the 6 months there. Now, you probably don't need to draw a little timeline diagram to understand what's going on here. But again, if it helps, it doesn't take very long, then do it. So that's what I've done for you here. In example 3, we have Z plc, accounting year ended year end 31st of March 21. It has made a trading loss. Whereas B Limited, that only started to trade on the 1st of October 20, prepared accounts for what was then a 6-month period through to the 31st of March 21, had a TTP. There are no numbers on this. Don't worry, in a moment's time in example 4, there will be more than enough numbers for you to play with. So all we have here to deal with is that only 6 months worth, only 6/12 of that trading loss would be eligible to be group relieved against the profit of B Limited. Now again, if for example that trading loss were to be £1 million, then 6/12 of 1 million would of course be £500,000. If this period of the 6 months to March 21 was a TTP of 200,000, then what loss relief would be available? Well, the available loss for the coterminous accounting period is 500,000. Let's put brackets around that. That is a loss figure. B Limited's profit is only 200,000 in that self-same 6-month period. So the maximum group relief, though 500,000 would have been available for group relief, only 200,000 group relief will apply. We limit it, of course, to the lower of the available loss or the available profit that is there within the claimant company to be relieved. So on that basis, 200,000. That, again, consistent with the example that we had in our classwork examples just a few minutes ago. If we now go back to our notes and we see what is a rather more challenging example 4. So what I'd like you to do just for 1 minute is to review through the information in example 4 and try to draw up your timeline. What you're going to discover here is that one company within the group is a loss maker. And we are then going to have 2 other companies within the group relieving group that are able to have some part of that loss relieved against their profits. What we'll deal with here is that those 2 companies, one, like with the example 3 that we've just done, starts partway through the period. Therefore, it's just a question of if all of that small period is consistent with what is the bigger loss-making period, then all of the profits are eligible to be relieved. The question is how many months of loss can go against those profits. And we've also got another company where we've got full 12-month periods, but they're non-coterminous. We use a different accounting date. Again, in terms of the loss-making period, time apportion. How much of the loss-making period belongs to how much of the profits of what won't be just one, but will be 2 profit-making periods. For this one, I certainly would recommend using your timeline. So get your head around the information there. Once you've got that, draw up your timeline with the loss-making company and then the 2 profit-making companies' accounting periods, and try to look then at what are the coterminous periods. Once you've done that, come back to me and we will proceed to look at what you've got compared to what I've got, and hopefully they'll be pretty much the same, and therefore we'll be able to determine the answer from that. So pause for a moment while you do that, please. Okay, let's see what we have therefore. Now what I tend to do is to identify the loss-making company and the loss-making period first of all, because that's the period that's going to be apportioned against potentially 1 or more periods of profit of 1 or more different companies within the group relieving group. So we had it that here Beyonce made a trading loss of £240,000 in its year ended the 31st of March 21. So it's got just that single loss making period, the year ended 31st of March 21, and a trading loss of 240. Now there are 2 other companies that concern us re the group relief that is available. the continuing company, which was J Limited here, and that has got taxable total profits, not just for one, but for two periods, both of which are partially coterminous with our loss-making period of Beyonce. It had £160,000 for its year ended 30th of June 20 and £280,000 for its year ended 30th of June 21 there. So we've got to look at what are these coterminous periods. For that, I suggested that you put together a little diagram. Let's see how that little diagram has now been constructed. Hopefully, something like this. Beyonce, the loss maker, there's your loss of 240, a single accounting period, year ended 31st of March 21. Now I've gone here with Z to begin with because Z is the easier of the two companies to deal with, again, consistent with what we looked at in the previous example and what before that we were looking at in our classwork example. It has started part way through the period. Again, going back to the question, we'd been told here that Z Limited started trading on the 1st of January 21, and thankfully it prepares accounts to the same date as does Beyonce, 3-month period through to 31st of March 21. So all of that profit-making period in which we made a profit of £50,000 corresponds with Beyonce's loss-making period. But of course, only 3 months worth of Beyonce's loss-making period, which is some £60,000 of loss, corresponds with the 3-month period of profit. So we've got 3/12 of 240, 60,000 loss available, but the profit is only £50,000. Therefore, the maximum group relief that we can have is the lower of the two, and that, of course, means it's £50,000 of group relief that would be available here. Remembering, of course, that with group relief, you can claim as much or as little of the available loss against the claimant company's available profits as you choose. So the maximum group relief here available to Z Limited, or Z if you prefer, is going to be £50,000. We've then got the slightly trickier problem, but hopefully not that tricky now that we've identified it in terms of our timeline. What have we got? J makes up accounts to 30th of June. We've got year ended 30th of June 20. Now that, along with the year ended June 21, they're both partially coterminous with Beyonce's loss-making period. The year ended 30th of June 20 there falls into, look, that's the year ended March 21, that began on the 1st of April 20. On the 1st of April 20 there. So what have we got? We have got a coterminous period of 3 months. So, in which case, just as we did a moment ago, although it's a different 3 months here, 3 months worth of the loss of £240,000 is available to be group relieved. That is £60,000. And that, of course, would now be available against the corresponding period is 3 months of J's year ended 30th of June 20. 3/12 of 160 will be £40,000. So again, although we have available 3 months of loss, which is £60,000, that £60,000 is bigger than the claimant company's profits, so the maximum amount of group relief, again, the maximum, is going to be £40,000. So, if 3 months of Beyonce's loss-making period here, of the year ended March 21, is, again, there consistent with the year ended 30th of June 20, there are 3 months that correspond in relation to that particular period. Then, of course, it must be 9 months worth of the year ended June 21. Well, of course it is. Beyonce's year end finished on the 31st of March 21. J's finished on the 30th of June 21, and therefore 9 months are consistent. So what have we got? In relation to the loss, there's our loss 240, 9/12 times the 240 loss. Well, that will equal £180,000. So 9 months of the 240 loss, 180 is available, is again there corresponding to 9 months worth of the profit of J of the year ended June 21. Now that profit, as we know, was 280. Well, 9/12 times 280, what's that going to be? That's going to be 280 divided by 4 would be 70, would be £210,000. 210,000. Well, which now is the smaller figure? The loss of 180. So this is telling us that all of that 180 loss, if you choose to use it in this way, would be available to go against the £210,000 of profit of J for its year ended 30th of June 21. So when you get what appear to be more complex problems, and that is simply because it is written in narrative form, company by company, accounting period by accounting period, that is difficult to know what type of brain you've got, but that's difficult to take in. There's all these different dates and all these different numbers and their profits and their losses and different amounts. Therefore, my suggestion when it gets that complicated, start with the loss-making period because it's its loss that you're looking to group relieve, and see, by comparison to one or more companies, which accounting periods of profit, and if relevant, with a non-coterminous accounting period end date, how many months of each of those profit periods do we correspond? Do your time apportionments accordingly, and you've got your figures, remembering that those represent the maximum amount of group relief available to you. Okay, hopefully that therefore covers us in relation to those two examples, 3 and 4, consistent with our FA 2019 notes. That is the material that we are using, but the FA 2018 lectures just had a different accounting period end date. I can now therefore happily return you back to the FA 2018 note, where again, in relation to any further issues here, it's only a question of issue a change of dates, or potentially the term chargeable accounting period being used instead of accounting period, which we're well aware of by now. Okay, now continue with the rest of the FA 2018 lecture.
Moving on from there for just a very small point, the situation of payment for group relief. The claimant company is obviously benefiting from receiving the loss from the surrendering company. Therefore, its tax charges are being reduced. It is getting a tangible cash saving in relation to the amount of tax that it pays by being able to use another company's loss. The surrendering company, of course, has given up that loss. Had it not given up that loss, it, even if it could not have used the loss now against its own profits, would have been able to carry forward that loss to reduce future profits, and if not save current tax, then save future tax. They have foregone that benefit. It may be seen to be reasonable, therefore, that the claimant company may make payments to the surrendering company for the group relief. Now, any payment up to the amount of the loss surrendered is ignored for corporation tax purposes. Now, normally, of course, the amount that would be involved would be the claimant company paying back the benefit of the tax saving that it achieved through using that group relief loss. It would pay back the benefit of that tax saving to the surrendering company. So the company that gave up the loss actually gets a cash benefit. The idea, of course, is not to disadvantage one company within the group while advantaging another. What we want is the best overall result for the group as a whole as compared to our dealings with HMRC. Now, a group can decide whether or not it wishes to make such payments. It doesn't have to. It's not compulsory. The group will decide. Quite often, where minority interests are involved, these payments will be made, or it may just seem to be just an equitable, that we compensate the loss maker for the cash benefit of the loss relief that they have foregone. If we do make these payments, then these payments and receipts are entirely outside the scope of the tax system. The payment does not represent a deduction in the corporate tax computation of the paying company, nor does the receipt of the benefit of that amount going to the surrendering company. That doesn't represent income in their corporate tax computation. So the payments and receipts, if any are made, are not involved within either company's corporate tax computations. They are outside the scope of the corporate tax comp. Now that leaves us with one further important area to deal with, still in the realm of 75% groups, and it's to deal with chargeable gains that arise within 75% groups. Now, before we look at the detail of what these rules are, we will discover that there is one rule that says if group companies do this, then this is the rule by which you deal with it. So it's not a matter of choice, it's not a matter of claim, it's not an election to be made by the companies. It is a rule which says if you do this, this is the way that it is dealt with for tax purposes. What there will also be within this area of group gains is a couple of elections that are available, that would be available, of course, to improve the tax position of the group as a whole when it comes to their capital gains position within that group. But first of all, who is within a group? We obviously talk about a 75% group. So a group consists of course, a parent company and its 75% subsidiaries. But of course, just as with group relief, there was an issue about, so how do we deal with indirect subsidiaries? So too, there is an issue for gains group purposes as well. So a group consists of a parent company and its 75% subs, and also the 75% subs of their subsidiaries. The parent company need only have an effective interest of over 50% in any sub-subsidiaries, any indirect subsidiary companies there. Now compare that with the situation that we had when dealing with group relief, where there were indirect subs to be able to group relief from a parent company to an indirect sub or vice versa. Then the effective interest between the parent company and the indirect sub, the sub-subsidiary, that had to be an effective 75%. And what we did was to draw up a little diagram such as that. Now, I don't think they were exactly the percentages we had, but they will be perfectly sufficient here. Now, what we discovered in this, the H group of companies, where we had direct and then indirect subsidiaries, was, for purposes of group relief, H, the holding company, could it group relief with S1? Yes, it could. It's 100%, that is effective 75. Could it group relief with S3? Yes, it could group relief with S3 because 100% of 80% was effective 80, satisfying the effective 75% interest. So the holding company was in a group for purposes of group relief, firstly with both S1 and S3. What about S2? Yes, the direct link from H to S2 is 90%. That is at least 75, so no problem. But then, of course, the effective link down to S4 was 90% of 80%, which equals 72%. That meant that S4 was unable to group relief with H, or with S1, or with S3. It wasn't a part of the H group for purposes of group relief. But of course, it was in its own separate group, there, S4 and S2. there we had an 80% link. So S4 could group relieve, but could only group relieve with S2. That's what we did for group relief purposes. What now happens in terms of capital gains? Right, look at the rules again here. The rule says group consists of group company and its 75% subs. But the group parent company need only have an effective interest of over 50% in any sub-subsidiaries. But the direct interest between parent and subs had to be 75, and also the 75% subsidiaries of their subsidiaries. Now read that and interpret it very carefully. Right. H and S4. Is S4 now in a gains group with the rest of the H group of companies? Is each direct link at least 75%? Yes, H to S2, 90%. S2 to S4, 80%. Both of those links are at least direct links of 75. What is the effective? 72%. Is that more than 50%? Yes, it is. The effective need only be, well, we can talk about 51%. Always by that we need more than 50% there. That therefore means that all of these companies, H, S1, S2, S3 and S4 are all in the same gains group. So we have a different interpretation of a 75% group when it comes to indirect subs for gains group purposes as compared to group relief purposes there. But be careful. A lot of students make the mistake here of simply thinking, oh yes, you have a gains group where the link from the parent company down to the indirect sub is at least effective 51%. And what an examiner might do to you is to therefore tell you that the link from S2 to S4 was 70%. What the unwary student does is to go 90% times 70% equals 63%. That therefore means it's okay, isn't it? That means that's effective 51, so it's in the gains group. Is that correct? Now I hope you are all responding no. S4 is not, cannot be in the gains group. Why? Because you failed the first primary condition, and that was that each direct link between the companies, H to S2, then S2 to S4, that each direct link was a minimum 75%. This is only 70%. So as soon as you saw that, this calculation here was totally irrelevant. So if when you saw those numbers, your first thought was, what's 90% of 70%, you were going to get it wrong, because that is irrelevant. The fact that 70 is not at least 75 means we don't care what the effective shareholding is. It cannot possibly be in a gains group with any group companies that exist here. So watch out for that in terms of, again, interpreting, for example, within an objective testing question. Okay, back to our notes now. Again, probably won't be an issue, but groups may be established through a parent company resident anywhere in the world. Remember, if we had H Inc., an overseas resident, non-UK resident company, and it had got S1 UK, S2 UK, and this was at least 75%, we'll call it 100, but at least 75%. What that meant for group relief purposes, I hope you recall, is that S1 and S2, the two UK companies, they are in the same 75% group, and even though they are held within that group by a non-UK resident parent company, doesn't matter. S1 and S2 were able to group relieve. Neither would be able to group relieve with the overseas parent company. So it would also be the case now that S1 and S2 would be in the same gains group. Not with H, of course, only together S1 and S2. And therefore the provisions, the tax implications we're about to discuss that relate to membership of a gains group would be applicable to both S1 and S2. So what are those tax implications therefore? Now, as we said here, there are three things we need to know about. One of them is a rule that says if the companies do this, then this will be the treatment. No ifs, no buts, no do we claim, don't we? There's no claim, it's a rule, that's an automatic application of that rule. So what is this? Group companies will transfer assets between themselves without incurring a chargeable gain or allowable loss. It's known as a no gain, no loss, or some texts will refer to a nil gain, nil loss transfer. So what we're doing is to transfer not at what is the market value of the property at the time, again, the most likely asset, the most likely chargeable asset will be a property, I would suggest to you, but whatever the chargeable asset is, we will not transfer that at market value, we'll transfer at a disposal consideration, a deemed disposal consideration that would give rise to neither a gain nor a loss. And that means it will be deemed to take place at a value equal to whatever was the transferor's cost of the asset, original cost plus any enhancement expenditure. So the cost of the asset to the transferor company plus the available indexation allowance, but remembering, of course, that indexation allowance runs only to December 17 at latest. So if the costs that we're talking about were incurred post-December 17, there is no indexation allowance on any cost incurred post-December 17, so from January 18 onwards. But if we're dealing with an asset that was acquired pre-December 17, that is now transferred within the group post-December 17, the no gain, no loss transfer value, the value at which we transfer it from 1, the transferor company, to 2, the transferee company, will be the cost or costs to the transferor company plus any indexation allowance available on those costs, and indexation is only available up to December 2017. Right, let's have a little look at an example to illustrate that. Here we go. In the example that we just had there, now if we go back to our original version of this, whereby all of the companies in this group were in the same gains group. So it's the original shareholdings where S2 to S4 is 80%. That meant that all 5 of those companies are in the same gains group. Assuming that has been the position for all dates and periods covered by the following example, let's have a little look at what you might have to deal with in an exam question. We're told that originally S3 buys a property in June 2010. Relevance of that is it's before December 17. It means, of course, that indexation allowance will be available on any disposal of that property that occurs post-December 17. Would have been available, of course, pre-December 17. But post-December 17, only indexation allowance up to December of 2017. Let us assume, therefore, that the original cost to S3 back in June 2010 was £1 million. We'll assume that indexation allowance to December 17 is 0.2 million. What, of course, you'd have been told there, potentially in an exam question to get you to work out that figure yourself, it would be a very simple exercise, of course, is that you'd be told that the indexation factor from June 2010 to December 2017 was 0.2. and obviously 0.2 times an allowable cost of 1 million, well, that would equal 0.2 million pounds there. That would be the indexation allowance. So it wouldn't be a difficult exercise for you to work it out for yourself. So the cost, 1 million, indexation to December 17, 200,000. That is as late, that is as far as indexation goes. And what then happens, now coming up to the current date, the accounting period that you have to deal with, May 2019, S3 sells the property to S4 at its open market value of £2 million. Now then, again, it is most likely that for accounting purposes it will indeed sell that at its market value. It happens to be 2 million. But what you have to recognise in terms of dealing both with S3 and with S4, both transferor and transferee, that both of those companies are in the same gains group. We've analysed our H group of companies and established that though S3 and S4 are both indirect subs, they are both within the same gains group. And what that means is that in May 2019, that it is a transfer at no gain, no loss. It's a no gain, no loss transfer. Now, what did we say that would always equate to? That will equal cost plus indexation allowance. What does that equal? The cost was 1 million. The indexation is 0.2 million, and therefore it's 1.2 million, no gain, no loss transfer value. So we ignore what was the market value at the time of transfer, £2 million, and instead neither a gain nor a loss arises on the transfer. S3 experiences neither a gain nor a loss. The transfer is at 1.2, so there's no gain or loss appearing in the corporate tax computation for this accounting period for S3, and it goes in at a base cost to S4 at that same no gain, no loss transfer value. So the deemed cost to be used by S4 on any subsequent disposal, should that and whenever that takes place, will not be the amount they actually paid for the property, £2 million. It will be the no gain, no loss transfer value of £1.2 million. So in October 2019, S4 sells the property to a party to a third party, i.e. an unconnected party, presumably an unconnected company, for 2.1 million. So how will we then compute the chargeable gain for S4? Sales proceeds, £2.1 million. Cost as a result of the no gain, no loss transfer, 1.2 million. The disposal, of course, is occurring in October 19, based on an acquisition that was in May 2019. So there is no indexation allowance now to apply. So the gain arising is £0.9 million. The gain is £0.9 million. Now again, following that, I hope logically through, from when the original company S3 bought at 1 million to the date of the no gain, no loss transfer, at which date indexation allowance was 0.2 million. Recognising it was a no gain, no loss transfer, we got the no gain, no loss transfer value of 1.2 million. S3 made neither a gain nor a loss. S4 deemed to have acquired, therefore, at a base cost of 1.2 million in the transfer date, May 19. As it's acquired in May 19, this is post-December 17, there will be no further indexation allowance to compute when S4 subsequently disposes of that property. The disposal in October 19 at its sales proceeds of 2.1, the base cost as a result of the no gain, no loss transfer, 1.2 million, The gain, therefore, £0.9 million. Have a little think about that, have a little rework back through, so pause just for one moment before we go any further, and make sure we're happy with what is the rule that applies within groups on transfers of chargeable assets between gains group members. They are always applied on a no gain, no loss transfer basis. Okay, now I said there were three things for us to be aware of when it came to dealing with gains group membership. The first of those, the no gain, no loss transfer rule, it is a rule, it applies, there is no question of claiming it or not claiming it. That is how an asset is transferred within a gains group. But then the next two issues, and we'll just have an introduction to these in this particular session, and then we'll finish off the detail of them in our final lecture on this chapter together next time. But group companies can make an election, this is gains group members of course, so that any part of a capital gain or capital loss incurred by one of these companies may be treated as arising in another company, in any other gains group member. So where you have gains or losses arising within a gains group member, what you are able to do, and this can be done retrospectively after the end of the accounting period, the detail of the admin as well we'll look at next time, what you can do after the end of the accounting period is to deem that any part of a gain or any part of a loss made by one gains group member may be treated as having been made by any other gains group member. It allows you to move gains as well as losses around within the 75% group at will. Once you know the gains and losses for each company, for each period, once you know the profits of each company within the group for each period, you can look again at the gains and losses and deem any part of a gain or loss made by one gains group member to have been made by any other. Now that is a flexibility that will prove to be, as we'll see in our next session together, incredibly useful. So the second of the two elections, the third point that we need to know about gains group membership is actually something we're already very familiar with, and that is rollover relief. And what it is that members of a 75% group, again the gains group, as treated as one for purposes of rollover relief. This is known as group rollover relief. Now, rollover relief, of course, arises where, if you claim it, where a company has disposed of a qualifying business asset, usually routinely a business property used within its trade. It sold off a business asset, made a gain, but within the relevant time scale for reinvestment, has reinvested some or hopefully all of those proceeds in another qualifying business asset, allowing some or all of the gain on the original disposal to be deferred through this claim for rollover relief. What this is now telling you is that when we have the disposal by a gains group member of such a qualifying business asset, the purchase of the qualifying business asset within again the qualifying time period, but the purchase of that asset need not be by the same company, the one that made the gain, i.e. one gains group member sells a qualifying business asset and a different gains group member buys a qualifying business asset. So the gain made on the sale may be deferred by, and hence the name rollover, by rolling over that gain against the base cost of the asset acquired by the other gains group member. So the principles of rollover relief are exactly the same, except this time it is not the same company doing both the selling and the buying. The selling company makes the gain, and its gain is deferred by referring it, rolling it over against the base cost of the asset acquired by the other gains group member. Okay, Now, we'll go into those two areas in more detail and talk about, amongst other things, the advantages of Gains Group membership, the claims these two elections that we're able to make and what that can achieve for us. We'll do that together in our next and final session on this chapter.